Improving your credit score is one of the most powerful financial moves you can make, because your credit score decides how much interest you pay, what loans you get approved for, what insurance rates you qualify. Let's begin by understanding the basics. Your credit score is usually measured on a range from 300 to 850. Anything above 750 is considered excellent, between 700 and 749 is good, 650 to 699 is fair, and below that is considered poor. But here's the truth most people don't know: your credit score is not fixed. It changes every single month depending on how you use your credit. That means your past mistakes do not decide your future. What matters now is what you do next. So let's go step by step. Step 1. Always pay your bills on time. Nothing affects your credit score more than payment history. It makes up 35% of your entire score. Even one late payment can stay on your report for 7 years. So the first habit you need is simple: never miss a payment. Set automatic payments, reminders, or calendar alerts. Paying on time is the fastest, easiest, and most guaranteed way to improve your score. Step 2. Lower your credit utilization ratio. This is the second biggest factor, making up 30% of your score. Credit utilization simply means how much credit you're using compared to how much you have. For example, if you have a $1,000 limit and you use $500, that's 50% utilization, which is too high. The rule is, keep your utilization under 30%, but if you want exceptional scores, try staying under 10%. You can improve this instantly by paying down balances, asking for a credit limit increase, or spreading expenses across different cards. Step 3. Don't close old accounts. Your length of credit history makes up 15% of your score. The longer you've had accounts open, the better. So even if you don't use an old credit card, keep it open unless it has a high annual fee. When you close an account, two things happen: you shorten your credit history and increase your utilization. Both hurt your score. Step 4. Avoid applying for too many new cards. Every time you apply for credit, you get a hard inquiry. Too many inquiries in a short time makes you look risky to lenders. It only affects your score a little, but when you're trying to build credit, every point matters. Apply for new credit only when absolutely needed. Step 5. Diversify your credit mix. This makes up 10% of your score. Lenders like to see that you can manage different types of credit cards, loans, auto financing, or a mortgage. You don't need everything, but having more than one type helps build your profile. However, never take a loan just for the sake of credit mix. Only borrow when necessary. Step 6. Remove errors from your credit report. You'd be shocked how many credit reports have mistakes. It could be a wrong balance, a forgotten closed account, or even someone else's debt appearing on your report. Review your credit report from all major bureaus, Experian, Equifax, and TransUnion. If you see mistakes, dispute them immediately. This can increase your score very quickly. Step 7. Pay off collections the right way. If you have accounts in collections, don't panic. Today, many newer scoring models ignore paid collections. That means if you settle or pay off collection accounts, your score can jump significantly. Contact collection agencies and ask for a pay for delete agreement, where they remove the negative mark once you pay. Many will agree. Step 8. Use a secured credit card if you're rebuilding. If your credit score is too low or you have no credit history at all, a secured credit card is a perfect starting point. You deposit money as your limit, then use it like a normal credit card. Pay on time, keep utilization low, and within 6 months you can start seeing real improvement. Step 9. Keep balances low every month. Some people think that keeping a balance helps your score. It does not. You don't need to carry debt to build credit. The smartest strategy is, spend a little, pay it off early, and repeat. This shows positive activity without risk. Step 10. Be patient and consistent. Credit building is slow at first but gets faster with time. Think of it like a fitness journey. One day at the gym won't make you muscular, but being consistent will transform you completely. Focus on good habits for the next 6 months, and you'll see your score rise steadily. Remember, your credit score is not about how much money you have. It's about how responsibly you manage your financial behavior. Even someone who earns very little can have an excellent score. And even high earners can have terrible scores if they misuse credit. So the power is always in your hands. Now imagine this: higher credit score means lower interest rates, easier approvals, cheaper loans, better housing options, and peace of mind. It's one of the few financial areas where small, consistent actions can unlock huge long-term benefits.